How central banks control the economy. Have you ever wondered how a group of economists sitting in a central bank can influence everything, from the price of your groceries to whether you get a loan for your dream house? Today, we're diving deep into how central banks control the economy and why their every move matters to you. What is a central bank? A central bank is like the brain of a country's financial system. It doesn't serve customers directly like your local bank. Instead, it sets the rules of the money game. Think of it like the thermostat in your house. It doesn't cook your food, but it makes sure the temperature stays just right. Key points. Examples: U.S. Federal Reserve, European Central Bank. Their main job: keep inflation low, unemployment manageable, and the financial system stable. The three main tools of a central bank. First up, interest rates. When the economy is too hot, prices rising too fast, central banks raise interest rates. That makes borrowing more expensive and saving more attractive, which cools down spending. On the flip side, if the economy is sluggish, they lower rates to encourage people and businesses to borrow and spend. Next, open market operations, a fancy term for buying or selling government bonds. If the central bank buys bonds, it pumps money into the system. If it sells them, it pulls money out. It's like the bank is watering or drying out the economy, depending on what it needs. Third tool, reserve requirements. This is the amount of money banks must hold in reserve and not lend out. Lowering the requirement means banks can lend more, increasing money flow. Raising it tightens the flow. Imagine you're managing a party. Lower reserve, more drinks, money flowing. Higher reserve, party slows down. Let's look at two real-life moments. In 2008, the financial crisis hit. Central banks slashed interest rates and pumped money into the system through a tool called quantitative easing. It helped avoid total collapse. Then in 2020, during the COVID shock, rates were dropped to nearly zero, and central banks again flooded the economy with money to keep things afloat. These actions kept businesses open and people employed, at least to some extent. Controlling an economy is a tightrope walk. Push too hard and you might cause inflation. Move too slowly, and unemployment can spike. Central banks are constantly analyzing data, trying to strike a balance, and markets react to their every word. Even a single sentence from the Federal Reserve Chair can move global markets. But here's the kicker: central banks don't always get it right. Sometimes they act too late or misjudge economic signals. They have powerful tools, but they can't predict everything. Pandemics, wars, supply shocks, you name it. So while they aim for stability, the economy is full of surprises. Understanding central banks helps you make smarter money decisions, whether you're taking out a mortgage, starting a business, or just wondering why prices keep rising. If you found this helpful, hit that like button, subscribe for more finance insights, and let me know in the comments. Should central banks have this much power?